The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Here on the eve of a rare Tuesday jobs report, the market's kept in check on this Monday. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Katie Greifeld. We're kicking you off the closing bell here in the United States on this Monday. It is the final full trading week of 2025, and the S&P 500, it's down very slightly. You could call that unchanged, but then you take a look at the NASDAQ 100, where your big tech names live, off by about 0.3%. The bond market, it's pretty well behaved. The yields actually were lower earlier in the session. We've given up that rally. You can see the 10-year yield pretty much unchanged at 418. And then I wanted to point out Bitcoin as well. I mean, looking up here, you can see there's not a ton of risk appetite to go around. That's very true in Bitcoin as well, Romaine, down by about 2.7%.
Kind of interesting for equities. Last week, we started in a bit of a holding pattern as the market awaited the Fed. And this Monday, we start in a holding pattern as well. A lot at stake for equity and bond traders alike this week. Traders betting on further rate cuts to support price rallies in both of those asset classes. The best read to date as to whether that will happen, maybe that's going to be found tomorrow on Tuesday's jobs report, a delayed release of non-farm payrolls data that will cover November and partial figures for October.
We get some of the data, not all of it, in terms of NFP. So there's a lot of data that's going to be missing, not just in the labour market, but also in inflation. It's very difficult to sort of interpolate across the days that you can actually collect the data.
Well, there's a labor market, and as for inflation, Fed Governor Stephen Miron is like, well, what inflation? At an event today in New York, he argued again that the central bank's policy stance is unnecessarily restrictive, pointing to his own personal benign outlook for inflation. Miron expecting shelter inflation to ease as rent increases normalize, and he sees services inflation kept in check by a cooling labor market. It's a solid argument, though we should point out he doesn't have a whole lot of company in those opinions. Now, the good thing for markets, if Miron does prove to be right, it will likely lead to lower Fed funds rates and a throughput to higher asset prices. Morgan Stanley strategist Mike Wilson making that case in his latest weekly note that moderate weakness in this week's U.S. jobs numbers that could further fuel bullishness towards stocks, a good is bad and bad is good regime centered around a higher probability for multiple rate cuts in 2026.
We won't have much longer to wait until 2026. I am counting down the days, but I wanted to take a look back at sort of the rotation trade that has been quietly developing under the hood. I have this chart pulled back to the start of October. We're taking a look at the KBW Banks Index, that's in white, and then you have the NASDAQ in blue, so your tech proxy there. And it's interesting that starting in December, really over there on that chart, you can see a bit of a divergence start to form. Tech pretty much treading water. It's still higher by 1.2% since the start of October, but take a look at what financials are doing, Romaine. You can see the KBW Banks Index higher by about 10%. The bulk of those gains and that outperformance really coming this month alone. So we know that December, it hasn't been kind to the overall benchmark so far this month, but certainly there's areas of outperformance. And
those areas of outperformance to a certain extent dependent on the direction of the Fed and more importantly, the direction of the economy. A K-shaped economy to be sure, and an economy that according to our next guest could start to see a U-shaped recovery. Jim Caron joins us right now, CIO of the Portfolio Solutions Group at Morgan Stanley Investment Management. And Jim, I do want to start with, I guess, the shape of the economy, or more importantly, the shape of that rebound here. Make the case for me why I should be betting on more of a U-shape on that chart.
Well, thanks, Romaine. If I'm going to assign a letter of the alphabet to the shape of the economy, it's going to be the letter U. And the reason is that 2025 and certainly the data over the past couple of months and likely even over the next couple is really signifying the mid-cycle slowdown. This is the trough. So we've come from a strong point in 24, a weaker point in 25 into the beginning of 2026. And I would expect that with all of the fiscal stimulus, whether that's on the corporate side from the from the Trump tax policies, or even on the personal side, where the consumer is likely to get somewhere on the order of $160 to $170 billion in stimulus, that is likely to lead to faster accelerated growth in the later half of 2026. But it's really a year of two halves, right? So I still think some of the weakness from 25 is going to filter over into 26. The jobs data is likely to remain weak. over the next couple of months. But then by the end of the first quarter, beginning of the second quarter, I do expect there to be a turnaround in that. And then all that stimulus that's coming in, plus the turnaround in jobs, is likely to create that letter U and create the upside into the second half of the year.
What are your thoughts on the potential for inflation, meaning inflation higher than where we're at right now? Stephen Myron, and for that matter, a couple other members of the Fed seem to think that's going to be kept in check next year.
Yeah, so inflation, higher inflation is the risk to my view, right? So if we do get higher inflation, then that's going to derail this U-shaped style recovery. I don't see inflation as a very high probability for next year. The reason is that a lot of the one-off effects of tariffs will already be worked through. So therefore, the year-over-year price gains, I think, are going to show lower inflation next year. Plus the fact that, Stephen Myron, I do agree with one thing that he's saying, is that if you do have a weaker labor market, then chances are that wage inflation remains relatively well in check, and that can keep goods inflation in check as well. So we're kind of at like a really interesting point in this economic cycle where you can have this fiscal stimulus from taxes in terms of corporate and on the personal side without having to pay the penalty of much higher inflation because the jobs market is somewhat weak. So therefore, the fact that the weakness in the jobs market is here actually gives a little bit of a buffer to all of the stimulus being non-inflationary. So you get the stimulus without having to pay for it in terms of inflation, which also, if inflation stays low, job market stays weak, it keeps the Fed in play.
Let's talk a little bit about the labor market. Of course, we're going to get that jobs report tomorrow. As Romaine said, a rare Tuesday read on the labor market, delayed for November, but we're catching up here. Are we really back to a bad news being good news regime here when you think about a weakening labor market and what that means for the Fed?
So that is the way that I'm looking at it, but it's within limitations, right? The news can't be so bad that it derails, any potential for growth and recovery. But what it does suggest, though, is that the markets are relying on the Fed to cut interest rates another 1 or possibly 2 times, or maybe even more than that. If you get a rapid reacceleration in the jobs market, which would likely lead to higher inflation, then we're not going to be talking about rate cuts. We're going to be talking about rate hikes. And if that's the case, that's going to change the whole narrative on things going forward, and that could create a deeper slowdown. So it's really that we're just going through a cycle. I don't like to use the phrase bad news is good news. It's really a question of where we are in the cycle. And the cycle is that jobs are slowing down, and that will allow, in this case, coincidentally, the Fed to continue to add accommodation.
And Jim, I'm curious, when you mentioned that risk for 2026, that sort of not close to base case scenario that actually this Fed has to cut rates, what would that mean for some of the most popular trades in the market right now? I'm thinking about the yield curve steepener in particular, which, a lot of folks have been calling for quite a while. And I can see that, it's one of your preferred places to be next year as well.
Yeah, exactly. So look, I think what it's really suggesting is that the Fed is lending support. It stands at the ready to lend support to support riskier assets. Now, I agree that the yield curve should continue to steepen. I'm still in that camp. But I think what you're getting at, Katie, is that if we get into a situation where we have all the stimulus and back-end rates start to go up quite a bit, that could be detrimental to other aspects of the markets. And what I think is likely to happen with some of the deregulation policies that are coming through, potentially with the next Fed chair and what's already underway, supplementary leverage ratios, the SLR, that this could create more bank buying of treasuries, and that could contain the back end of the yield curve and not allow it just to run really, really high and create a disruptive mechanism for the remaining part of the equity market. So I do think that back end yields can moderate, can maybe even go up from here a little bit next year, but I think it's going to be somewhat minor.
All right, Jim, always a pleasure. Jim Caron, CIO of the Portfolio Solutions Group over at Morgan Stanley Investment Management, kicking us off to the close here on this Monday afternoon as we count you down to the closing bells, a closer look at the pharmaceutical sector and the healthcare sector. A broad discussion up ahead with Dr. Marty Makary, the Commissioner of the Food and Drug Administration. That's coming up next here on The Close. This is Bloomberg.
Well, we're keeping an eye on shares of Moderna and Pfizer's after the FDA is said to be investigating whether COVID-19 vaccines potentially cause deaths in adults as part of a safety review. The investigation comes at a time when HHS Secretary RFK Jr. has repeatedly questioned the safety of the shots, despite numerous studies proving their efficacy. Let's discuss with Dr. Marty Makary. He is the Commissioner of the Food and Drug Administration. Doctor, great to see you on set.
Good to be here, Katie, Romaine.
So let's start there. A spokesperson sent a statement to Bloomberg last Tuesday that the FDA is doing a thorough investigation across multiple age groups here of deaths potentially related to COVID vaccines. What is the end goal for this inquiry?
So first of all, it's been known that there have been rare cases of death following the COVID shot. That's been published in the New England Journal of Medicine. It came out in a Senate subcommittee report. And we have patient testimonials from families out there. So this is nothing new. But the moral dilemma when we came into office is that under the Biden administration, there were cases reported to the FDA. And the question is, should they be public information or not? So we believe they should. But we wanted to make sure that, in fact, there was truly a link between the COVID shot and the death before we make it public.
And so CNN also reported in the past week or so that the FDA is considering a black box warning on COVID vaccines. And just for the audience, a black box warning is one of the strongest pieces of caution out there. So this is a bit of a two-part question. First of all, whether or not the FDA is looking at that. And when you think about the risks of the disease itself, whether putting such a warning on sort of matches that risk-reward balance.
Well, first of all, it's up to doctors whether or not to recommend it. And we are generally in the United States moving towards the same model they use in Europe. That is a risk-stratified approach as opposed to an absolute recommendation for every single person, including young, healthy children. Does a 6-year-old girl need another 70 COVID shots, one each year for the rest of her life? That's a theory. It's a scientific unknown. In France, you have to be 80 years old to have the shot recommended or high risk. In the UK, I think it's 75. So we're just moving more towards that risk stratified approach internationally. Now, when it comes to the black box warning, we have no plans to put that on the COVID vaccine. The Safety and Epidemiology Center within the FDA did recommend that. It was a recommendation formally put out. But some of our scientists and leadership, like Dr. Vinay Prasad, have said it may be different today than it was in the first year of COVID when the shot came out, because when you have those two doses 3 months apart, that's when you see the side effects go way up, like myocarditis in young people. Now that it's annual, you may not see that same prevalence, so we don't want to extrapolate findings to today if it's not transferable.
I am curious, and this broadens it out beyond just COVID, but overall, the reviews that the FDA takes on existing drugs and applications out there relative to new ones coming in. How do you balance out the need to sort of speed up the initial application process with this idea that, of course, drug makers don't necessarily like you coming back to them after something's been approved and saying, okay, we need now to vet this all over again?
Well, I mean, we have a simple process. Companies present data to us, and we decide whether or not the claims that companies want to make about their products match the data they've submitted. Mm-hmm. So it's a pretty simple process. If a drug works and it's safe, it's going to get approved by the FDA. We took a big step this year in the spirit of transparency to make all FDA rejection letters public information, because if we don't accept a drug, the public deserves to know why. Mm-hmm. It also reduces corporate spin to investors of a company when they're told that, hey, the FDA wanted one little tweak. Well, that may not be the case.
Well, on the issue of transparency, I mean, you guys had an announcement this morning about a move to sort of using more real-world evidence in the approval of applications. But I am curious, was the issue that you didn't have access to that information, or was the issue that you didn't necessarily, it wasn't transparent enough? You didn't actually know who these people were and what the circumstances of that evidence were?
The issue is the bureaucracy of the FDA created such rigorous requirements for real-world evidence to be submitted with applications that a lot of real-world evidence just didn't qualify. I mean, the FDA had said you basically need to have patient-level specific information or the ability to drill down to that. Well, that requires informed consent from an individual. So most of the large databases, the Medicare database, for example, the SEER database, the Swedish database, these large databases you can actually see pretty granular things happening in those big databases, but companies haven't been able to submit it. So we're saying you can submit whatever you want.
Right.
We're going to still hold high scientific standards, but at least give companies the ability to submit data.
Is the informed consent still in place, or is that being removed?
So we're still requiring a pivotal phase 3 randomized control trial. That's the gold standard. Now, earlier this year, just a couple weeks ago, actually, we said we're going to go from a baseline 2 randomized control trials required for a drug to a baseline 1 with exceptions. And if we allow real-world evidence to be looked at, for example, with rare diseases, that's really important. We are going down to reduce the investment required. You can actually achieve better statistical significance with one well-powered, well-designed, well-controlled single randomized trial than you can with 2 mathematically. So we just need to modernize the agency and incorporate new Bayesian statistics.
Well, I want to switch gears briefly from the announcement that you made this morning to something that was said by the FDA at a panel last week. This is about testosterone products, and we were talking about black box warnings earlier. You said, or the FDA said at a panel last week, that it's open to making changes on black box warnings for testosterone products. Just walk us through the thinking there. Why now?
Well, about 4 weeks ago, we announced we're removing the black box warnings on hormone replacement therapy for postmenopausal women. We got a tremendous positive response. We're setting the record straight after 22 years of dogma that has scared women away from that powerful treatment that has profound long-term health benefits. And so we turned our attention this week to men's health. And so we had experts come in and talk about the fact that over a third of men over age 45 have low testosterone. Many have symptoms, including mood decrease, depression sometimes, vitality being lower, libido being lower. Many men have symptoms, but we never talk about the topic. It's like it's taboo. This is a part of public health. It is a part of why doctors come in to why patients come in to see their doctors. And so we want to remove the stigma. Consider removing it as a Schedule III controlled substance, because it was made a Schedule III controlled substance in the 1980s and 90s during the Olympic doping scandals. Now the scientific community has matured to understand the benefits of testosterone therapy. So we're considering, we removed the black box warning earlier this year at the FDA, and we're getting all that information out for individuals and men across the country. 10 million men take testosterone, and more people need to know about it.
When do you think there'll be more of a formal decision on this?
I would say in the next couple months, perhaps. I mean, we already took the action to clear up the dogma that it increases that testosterone therapy increases cardiovascular disease. We removed that black box warning earlier this year. It does not cause prostate cancer. So we're trying to tell people the truth and cut through the dogma so that men who have low vitality, depression, or whatever their symptom is from low testosterone can consider this option objectively without the stigma that they're a drug addict or that they really shouldn't be on it. This is medical science, and so we have to apply basic scientific rigor to this issue of low testosterone in men.
All right, Marty, I have to leave it there. Always a pleasure. Dr. Marty Makary is the commissioner of the FDA. We'll be back in a moment. This is Bloomberg. All right, time now for our top calls. An eye on analyst action, and Roth Capital Partners cutting Costco today to sell, becoming one of only 2 ratings on the street right now with that sell rating. The analysts also slashing the price target to $7.69. Concerns here about fading renewal rates, a slowdown in foot traffic, and intensifying competition from BJ's and Sam's Club. Pleased to say the man behind that call joins us right now, Bill Kirk, Managing Director, Senior Research Analyst over at Roth Capital Partners. All right, Bill, let's start off first. I'm curious about the issue of renewal rates here, because this is like the first time I've heard any real concern about that. What have you seen, and why are you concerned?
Yes, thanks for having me. So, renewal rates are a measure of satisfaction, right? They're a measure of customer, in this case, member satisfaction for Costco. And a few quarters now in a row, renewal rates have ticked down. It's not a giant step function. It's a few basis points quarter over quarter, but it's now a few quarters in a row. And so renewal rates have shifted down. You mentioned traffic. Traffic has also decelerated, right? It's about 3 points off where it had been. So traffic has decelerated, and we're seeing the paid members the incremental paid members they're able to add each quarter over quarter, decelerate as well. So one of those metrics alone wouldn't be enough, but you put the three together, paid members, renewal rates, traffic, all three moving in the wrong direction is what got us here where we are today.
Yeah, triple crown, but to the downside. Let's talk about the competitive landscape a little bit, because you have Costco with the paid membership. You also have Walmart's Sam's Club, BJ's has BJ's Wholesale. I wonder, where Costco currently stacks up there.
Yeah, Costco enjoyed a number of years of stagnant Sam's Club and stagnant BJ's, and that's no longer the case. Walmart is investing aggressively behind Sam's Club. They're opening more stores. They're putting a lot of new tech in the stores that Costco doesn't have yet. And so we've seen Sam's Club results get better. And BJ's is doing something similar. They used to only invest about $200 million a year behind their fleet. They're now investing $700 million a year. So you have a 3x increase in what BJ's is doing as well. So you have increased competition against Costco that is new, is something that didn't exist for a while. And what we did to kind of triangulate this is we looked at Yelp ratings. We compared them, the warehouse clubs, against each other, but also against themselves from 2020. And what we saw using Yelp ratings, the Sam's Club stores had more locations improve in satisfaction from 2020 than did Costco. So Sam's Club, via Walmart investment, is narrowing the gap to Costco.
I am curious, too, about when you look at Costco's business model over the years. You also had something in your note about the demographic shifts, the idea of smaller households, smaller families who maybe aren't going to be as reliant on a Costco given the bulk nature of a lot of the goods.
I think that's right. It's a slow trend, but it's a persistent trend, right? It's smaller households, delayed household formation, and when you go through a period like COVID, that doesn't matter as much, right? People were willing to take extra inventory. They wanted extra bulk product at their house, so they were willing to be bulk shoppers even if they wouldn't normally. And then following COVID, you went through a period of kind of heightened inflation, so people were very sensitive to food prices, but Costco offered a nice value alternative. They have rather cheap, especially on a per unit basis, food prices. So they benefited in ways that maybe masked this demographic headwind that they face.
All right, Bill, really appreciate your time. That is Bill Kirk. He is Managing Director and Senior Research Analyst over at Roth Capital Partners. Now coming up, recent cracks in the crypto trade aren't deterring Robinhood from its push to expand the market in 2026. We'll discuss next. This is The Close.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on the snow, keeping an eye on equities.
Snowfall here in New York City this season. It was beautiful out.
That was a heavy snow for December.
It was.
I was pretty thrilled.
I was thrilled too.
Yeah.
Waking up and seeing all the
Felt like
snow-covered
Christmas.
trees. Smelled like Christmas.
Yeah, and then I was like, no, wait.
Then I had to walk outside.
Still have 2 weeks of work left. Let's talk about crypto a little bit. Of course, we've been watching Bitcoin closely. It's now down about 30% from its October peak. And we know that it saw a little bit in the last few weeks, maybe a little bit of momentum coming back, but it feels like it just can't hold that bid, Romaine.
Yeah, it can't hold that bid. I guess if there's only a good silver line in all this, there does seem to be a bit of a floor here in that mid-80s level, obviously being tested again today. But remember, we had this tested a few weeks ago, and it survived. We'll see what happens this time around.
Yeah, absolutely, especially as we enter the last few weeks of the year when we know that liquidity and trading volume tends to dry up a little bit. But our next guest is all too familiar with crypto swings, and they haven't exactly deterred him or his firm from their mission to make crypto infrastructure essential to our financial system. Joining us live, I'm pleased to say, is Johann Kerbrat. He is Senior Vice President and General Manager of Crypto at Robinhood. Johann, great to have you with us. Let's first talk about what you're seeing in terms of sentiment and activity. We know that the past couple months have certainly been rough for crypto in terms of price action. How has that translated through into trading volumes?
Yeah, that's really true. Like the price have come down quite a bit. But what we see from our customer base is really depending on the segment that you're looking at. For a lot of our customers, they are on the younger side, and so they have price horizon that is a bit longer than some people, and so for them they are looking at buying the deep opportunity, and so they are still investing quite a bit. What we see also from other segment is that they are looking into options to stake their assets and get yield on the cryptocurrency. But overall, what is a good sign for us is that we still see a lot of people buying on Robinhood and then transferring into DeFi, showing that there is still a lot of activity on the crypto networks.
Let's talk about staking a little bit. Taking a look at the notes you sent to our producers, and you note that Robinhood, ETH, and Solana staking went live for New York customers on December 9th. It's only been a couple of days, of course, but what has that uptake looked like so far? And if you can give us any numbers, that would be great.
Yeah, I think it's too soon for the numbers just because we only recently launched it, but that was something that we were really excited about for New York. For a very long time, our customer could not access crypto transfer and staking, and so we think it's an early holiday gift for them that they are able to do it in New York now.
Johann, can you talk a little bit also just about some of the add-on features, particularly designed to help crypto investors kind of navigate the complexities of tax law, particularly here in the United States? When do those roll out? Have folks started to use them yet, and to what degree?
Yeah, so on Robinhood, it's one of the only platform where you can actually get a 1099 at the end of the year. Well, at least at the beginning of next year for your tax season, and we give it to you for free. Like, you don't need to have a subscription or anything like that. But one thing that we started to notice is that people that are very active on DeFi are starting to lose track of their cost basis. So we rolled out this feature where you can actually input the cost basis of your purchase, just to help the customer manage their taxes. But I think for us, one of the main focus this year has been to really push on advanced traders, the people that are a bit more than just the normal customer just focusing on buying or selling a little bit of crypto once in a while. And we really push on new features for the people that are trading tens of thousands of crypto a day or up to millions a day. And so now we have one of the lowest fee at 3 basis points for this very advanced trader. So that was something that we were really excited about, because for a very long time, people thought about Robinhood as more of a platform for simpler investor. And so we wanted to make sure that even advanced investors have all the platform and all the tools that they need for that.
What's the difference between how you're structuring that here in the United States versus what you're doing with your products over in Europe?
It's similar in the sense of in the US you have different volume tiers, so based on how much you're going to trade on a monthly basis and what version of our trading system you're going to use, you'll have a lower fee. In Europe right now we still have only one fee, but it's something that we'll bring also in the future. So definitely something that is coming there.
Well, let's talk about Robinhood's presence in Europe a little bit more, because it's interesting to think about the differences versus your presence in the United States. For example, I see that Robinhood is still mobile app only in the EU. When might we expect that to change?
Yes, we are going to start rolling out the web experience in the next couple of weeks for all our customers. And really, the decision behind this was getting and meeting our customer where they are. And so we saw that a lot of our European customer wanted a better mobile experience than what the competitors were offering. And so that's why we rolled out mobile first. But they also have features that we don't have in the US. So for example, perpetual is something that we do not offer in the US, and our European customers are able to access multiple contracts and up to 7x in average.
So, Johann, talk a little bit here as sort of you evolve, and more importantly, I guess, as the institutional and individual investor space evolves deeper over the next couple of years here. Is this going to be a meaningful accretion overall to Robinhood's business, or have we kind of reached, to a certain extent, for lack of a better phrase, critical mass with regards to users?
No, I think, we are just at the beginning. If you look about what our competitors are doing is just starting to add crypto to their platform, showing that, still for the longest time in the US, you have the majority of the population that do not have access to crypto. And I think you're also at the beginning of using the technology to actually replace the traditional finance system. We started to do it in the EU with tokenized assets like stock tokens that give you an exposure to US stocks and ETF. And that's basically the the beginning of how we can use the blockchain technology to accelerate and improve our current system that is still, shutting down over the weekend, or where you still have to wait one business day to settle.
All right, Johann, really appreciate you taking time for us. Johann Kerbrat, Senior Vice President and General Manager of Crypto over at Robinhood, as we keep an eye, Katie, on the world's largest crypto currency, Bitcoin, down back below that 86,000 level. And I was kind of looking just at a one-year chart. And it has been a roller coaster. Not that you would expect anything less from crypto, but it's been quite remarkable to think, we had that big run up to over 100 grand, and we kind of started the year around 100 grand. Had that big run up, and we've kind of given all that back and then some. And now it looks like we're going to potentially close out the year not far from some of the lowest levels of the year. Unless
something amazing happens, which it might.
Well, you got 2 weeks to figure it out, Katie.
Exactly. Well, we know that crypto volatility is the name of the game. What I find interesting is that you take a look at Robinhood's year-to-date performance. The stock is higher by more than 200% year-to-date on a total return basis. So not exactly correlated.
That's better than crypto.
Better than crypto. You might expect more of a relationship between crypto and Robinhood shares, since we know that Robinhood is popular among crypto traders, but that hasn't been the case. And also point out that this would be the second year of triple-digit gains for Robinhood shares. It's been on an incredible run.
An incredible run, and of course you think about all the doubters when this first went public, whether they could really evolve beyond just the confetti and all that, and now they're a full-fledged financial company right now. Bank charter next?
Yeah, maybe. Who knows?
All right, when we come back, we're going to take a look at some of the big movers on the day, and that includes ServiceNow, a drop of almost 11%. Analysts up in arms about its deal to buy Armis. That's our stock of the hour, and it's coming up next. This is The Close on Bloomberg. Time now for our stock of the hour. A closer look at ServiceNow. The shares having their worst day since at least January on the back of a Bloomberg scoop that the software company is in talks to buy the cybersecurity startup Armis. It's a deal that could be valued at up to $7 billion. Bloomberg Intelligence says the deal would help ServiceNow's IT asset management practice, but the reported price seems expensive. Anurag Rana joining us right now, senior tech analyst over at Bloomberg Intelligence. So the market reaction, this is all just because maybe the valuation is just a little bit too rich?
I think there are 2 points of it. One is absolutely why do you need to spend this much money to buy, let's say, $300 million in revenue? But the biggest question is, what is really happening with the end markets for ServiceNow that they have to go out and acquire at this point? The biggest narrative for ServiceNow for the longest period has been that they have a very large and untapped total addressable market, which they have been monetizing very well over the last several years. Organic sales growth of above 20% for a while. And are we coming to a point when that sales growth falls into the high teens rather than 20% plus? And if that happens, then you don't get the same multiple for the stock as you get when somebody is growing above 20%.
Well, to that point, this would be their second cybersecurity acquisition this year. Remember, of course, ServiceNow agreed to buy identity security startup Visa, I believe it's pronounced, for more than $1 billion in early December. How do these two potential acquisitions fit together, and what do they say in combination about that end market?
So one of the things is part of what ServiceNow does is called IT service management, or the help desk tickets. It also does IT operations management, trying to see how your data is coming in and out. And the last thing is the IT assets management, which is the physical products. In this case, it expands on a lot of these offerings because in the world of AI, when you start using LLMs, the cybersecurity risk goes up quite a bit. So when you're offering any software product to the end client, if you have security infused in it, it typically should run better, or you can go down to that same customer base and sell those products. So there is some logic to it. We don't think there is synergy there. But the big question is, why spend this much money?
Why spend this much money? Also, why was something of this nature, cybersecurity-wise, not already embedded in ServiceNow already? Is there a reason?
So, Romain, in most cases, there is some element of cybersecurity present in these products, but it is not top of the class or what you call a best of breed. And that's where a company will go out to some of these, extra or outside cybersecurity vendors to get that technology. And that's not just common in this place. It's throughout the ecosystem, whether it is even Windows, frankly, you do have to go out, or for that matter, your network. So there are pure play cybersecurity companies that have specialization in one area, and you want to have that embedded in your software package.
And Anurag, we only have about 30 seconds left, but again, this deal for ARMA is said to near up to $7 billion. You called that as expensive, seeming expensive. What would be a more reasonable price tag for this deal?
See, one of the things is when you have an annual run rate of 300 million, and last year it was 200 million, one would argue with somebody growing that fast, you want to pay a multiple. But 23 times sales is a big multiple. Somewhere around 10 to 12 times is more reasonable in our view.
All right, Anurag, great to get an update with you. Really appreciate it. That is Anurag Rana. He is Senior Tech Analyst for Bloomberg Intelligence. Now, coming up, we'll take you to the closing bell with Kate El-Hillow. She is President and CIO over at Russell Investments. That conversation coming up next. This is The Close.
What I think is likely to happen with some of the deregulation policies that are coming through, potentially with the next Fed chair and what's already underway, that this could create more bank buying of treasuries, and that could contain the back end of the yield curve and not allow it just to run really, really high and create a disruptive mechanism for the remaining part of the equity markets.
Jim Caron over at Morgan Stanley Investment Management kicked us off to the close just about 50 minutes ago on this Monday. And I'm told, Katie Greifeld,
yes,
the last full trading week of the year. I don't know who told me that.
It was me, because
okay.
I am keeping close count. We are so close. Let's talk about what the market is doing, though. The S&P 500 still lower on the day, just barely, but it still counts because it's in the red. Interestingly, it's Broadcom that's one of your biggest losers on a points basis right now. Still some indigestion from earnings last week. You can see that's a weight on the NASDAQ 100. The bond market not doing too much.
Not doing too much. Maybe a bit of a holding pattern as we wait for Jobs Tuesday.
Yes.
Doesn't quite have the same ring as Jobs Friday, but of course those data points as they start to roll in, that'll affect some of those bets on where the Fed goes next.
Yeah, absolutely. It'll be interesting to see what impact it has in the bond market. Morgan Stanley's Mike Wilson did say that a weak jobs report would be good news for the stock market, so we'll just have to see.
Yeah, we will have to see as we close out 2025 and push ahead to a look to 2026 and what it might actually mean for the markets. Kate El-Hillow joins us right now, President and CIO at Russell Investments. Kate, great to see you.
Great to see you.
You are looking at 2026 as a potential inflection point from a macro basis. Explain.
Yeah, well, after the policy shock characterization of 2025, it was amazing how resilient the market was, and obviously AI was the path to that. But the inflection point in 26, we think, are three things that could drive that. One is really a broadening out in AI. And, a lot has been around the big infrastructure players, hyperscalers, but really starting to get, going from, let's say, the builders to the users of AI and starting to stretch out into things like financials and healthcare. Certainly utilities continuing to be part of that, but seeing a broadening out of the AI trade into other sectors, and over time, like particular companies that are getting it right quicker. The second, big thing, potential reacceleration in the U.S. economy. Back to like tariffs and immigration being a challenge for a lot of the year, the market getting through that uncertainty. You start 26 with some fiscal support that's going to help both corporates and consumers, but also with the markets up and just say, financial conditions being a bit looser, there's just more money, at least for the upper half of spenders, to continue to keep the economy going. So we think that there could be some positive reacceleration here in the U.S. And then hopefully we continue to see maybe more persistent broadening across the globe. Throughout the year, we had like fits and starts of certain regions or sectors, seeming like they were going to start to kind of join in to the rally, but it didn't hold for long periods of time. We think that broadening out could start, whether you look at Europe and maybe some of the cyclicals there, you've got 2% inflation, you've got like a more balanced labor market, rates and policies starting to kind of normalize there, and then fiscal support potentially from Germany and others. It could start to see things like Europe, also in emerging markets.
Well, that's what I'm curious about. I mean, it's funny you mentioned that. I mean, we've actually seen, despite the gains, the phenomenal gains we've had here in the U.S., we've actually seen a lot of outperformance, particularly in terms of EM and in certain markets in Europe as well. Do you think we'll see outperformance, at least in public markets, from Europe, from Asia, from emerging markets?
I think it's going to start to get into particular sectors and particular companies, right? And I think that if you go back to like where valuations are, it is still pretty mixed, across whatever index you look at. And so really starting to find the sectors of the companies that might have been underloved and then might be in a period of better fundamental support and policy support, starting to find some of those names. But even like you take like EM Tech, it's been a strong year for that. Some of that's reform based, whether it's South Korea or China, and you see that could still persist. And so I just say it's this AI trade will continue to power a lot of the market, but we do think it's going to broaden out.
Well, it's interesting to hear that because there was a great story over the weekend on the Bloomberg terminal about Wall Street basically saying to skip tech and go for old school sort of sectors for growth in 2026. Specifically, you had the likes of Bank of America, Morgan Stanley, telling people that they should take a look at healthcare, industrials, and energy. How does that sort of fit into the framework that you're describing?
Well, I think some of the cyclicals and or like this reacceleration story fits nicely. And you think about like financials and healthcare, whether the AI trade in terms of productivity, efficiencies start to play out in certain sectors or particular companies, the market will start to see that and start to price that in. So we do think that things like financials, healthcare, even industrials with maybe some more advanced automation, getting kind of the benefit of AI, you could start to see this come into like a broader set of companies. But I think financials, healthcare, utilities, we all think could be supported.
And when you say, you talk about this broadening, is this sort of a catch up of those sort of sectors to where tech is in 2025, or is this tech maybe cooling off a little?
Yeah, so our view is that it's more of a catch up versus a catch down from the stuff that has done well. That some of that stuff is lofty. We've seen it with a couple of names struggling over the last couple of weeks as earnings go through. But we think it's more other things catching up and other sectors catching up versus a pullback.
I want to talk a little bit about private markets and the balance between allocating more to private assets relative to public assets in the portfolio. How much reallocation, if at all, are you expecting to see beyond this year as more of those products become available to a broader pool of people?
Yeah, I still think a majority of clients, investors, asset owners are underallocated as it relates to private markets. Part of that is because that market's just growing so much in terms of where capital is getting formed. In terms of the credit markets, there's still so much more room to run. Even if you look at IG private credit and some of the opportunities there, whether you're a pension plan or a hospital system, there's just some very interesting asset-backed based debt that you can be buying. Like it's good yield, a good structure and protection that you can find in some of these private market and private credit assets. And so when you think about allocating to credit, in my view, you should look at it, public or private, like which makes most sense based on liquidity, the level of duration or rate sensitivity that you might want to have in the portfolio. The benefit of adding privates to the portfolio, there's so many characteristics that you can't get just from allocating to the public markets, and vice versa, right? We like the liquidity of the public markets.
Yeah.
And,
We only have about 30 seconds left with you, but when you think about the private markets, how comfortable are you going out the risk spectrum? Because you mentioned, of course, IG private, for example.
Yeah, I mean, I think with anything, strategy selection, particularly kind of where we are kind of in the cycle and with some potential complexity still existing in the market, you need to be smart about not stretching for yield and thinking through high quality, where possible, and then what really aligns with the outcome that you're trying to achieve. Don't stretch for something. Don't try to get extra growth if you don't need it. Go where it makes sense for the portfolio.
All right, Kate, great conversation. Great to have you here on set. Kate El-Hillow, President and CIO over at Russell Investments, counting us down to the closing bells. Katie, 2.5 minutes to go with the market. We can say it's on the back foot, but really, once again, a bit of a holding pattern as we await more economic data.
Absolutely. Certainly volume leaving something to be desired. We are about 2.5% below the 30-day trading volume when it comes to the S&P 500.
A slight elevation on the VIX, a slight dip in yields, at least on the shorter end of the curve, and not a whole lot of bids going into any of the sectors. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld here to take you through to that closing bell with the global simulcast. We're joined now by Carol Masser and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms. That's television, that's radio, and that includes our partnership with YouTube. And for those folks watching right now, if you are confused as to why Tim and Carol were out of the fishbowl and into a new aquarium, well, there you have it. you're getting a little bit of room, Carol Massar, to swim.
A little bit. We're the same people.
You got
though,
a new
okay?
studio. How did you finagle this?
We know important people. What can I tell you?
Apparently. It looks good.
It's still, the important thing is it's still us. You're still stuck with us, okay?
Yeah. I'm still going to stumble as I speak.
I feel like the magic of the simulcast was the old fishbowl.
Well, you know what? If it's open. So if you'd like to go there. No, we're going to try and keep the magic that the four of us have, because it's certainly something we love to do. Hey, having said that, nothing really magic, I feel like, in the markets today. I feel like we're just limping along when it comes certainly to the equity trade and a lot of asset classes out there. But we do have some data coming our way, although as we talked to our Mike McKee earlier, it's not going to necessarily be complete, so we're not quite sure how it will shape the trade going forward.
Yeah, a little bit of an incomplete and late data, better than no data, but still kind of weird tomorrow, Katie. Carol mentioned not much of magic in today's market. Also, if you look at Bitcoin, that 93,000 didn't hold for very long. We're getting close to lows for the year.
Yeah,
if you look at Bitcoin today.
It's brutal out there when you take a look at the cryptosphere, especially over the last year. As you mentioned, Bitcoin, it could finish up on its lows of the years. We'd have just a couple weeks left.
As we get the closing bells here in New York, it is going to be red across the screen for most of the major indices here in the U.S. and some key technical levels now being tested to the downside. You take a look on the far right of your screen, the NASDAQ composite down about 138 points and change, down about 0.6%, but more importantly, now firmly below that 50-day moving average. The S&P stopping just short of that 50-day moving average, but still losing about 11 points or about 0.2% after hitting that record high last week. The Dow Jones Industrial Average, we'll basically call it flat on the day. It's down roughly about 41 points or about 0.1%. And the Russell 2000, that's your main laggard here on the day, lower by 21 points or 0.8%.
All right. So though only a little bit lower on the S&P 500, you did actually have 281 names to the upside on this Monday. And Katie, about 218 names losing ground.
All right, let's take a look at the sector level. It's interesting, even though it was a down day at the index level, you had more green than red when it comes to the sector level. Healthcare having a great day, utilities, consumer discretionary also enjoying in that rally. In terms of what didn't do well, and this is the important part, information technology off by about 1%. Broadcom still nursing losses, and that was a big weight on the index overall, Carol.
All right, so let's get to some of the individual gainers. Courtesy of my co-host, Tim, I'm doing Tesla, which is the top gainer in both the NASDAQ 100 and S&P 500. Maybe it's something about December, because at one point rallying today that if it had closed, it would have been its first all-time high close for the stock this year, but it did not make it. But still up about 3.5% in today's session. So we'll keep a watch, see what we have. We still have a few, what about, are you yawning?
No.
Wow,
No.
Yawning.
I wasn't.
He was yawning. Anyway, we could see we could see an all-time high for Tesla for the
I'm
first
just wondering,
time
you
this
only
year.
have 3 gainers today.
I know. Well, what can I
What
tell
is
you?
it?
I don't know.
Okay.
I'm
It's the end of the year.
Little mellow. Yeah, exactly. Mellow Monday. Hey, let's go to KLA Corp. It is up 2.6%. It was up as much as 5% in today's session, finishing with a 2.6% gain. Upgraded to buy from hold at Jefferies, which sees AI tailwinds for the semiconductor capital equipment company into 2026. This is Blaine Curtis over at Jefferies. He actually likes a bunch of chip companies. I just want to throw them out there because I think KLA was really the only one that rallied in today's session. He also likes Broadcom, NVIDIA, and KLA. He said they are among his best chip stock ideas for 2026, but KLA Corp actually outperforming today.
Can you
Sorry.
say KLA one more time?
No, I know. Okay.
Thank you.
What stock was that about? It's nice to know news studio, but like some things never
old
Let me
change.
just say, your shot actually looks great, Carol.
That's
The
amazing.
lighting,
You know,
you don't have that camera up your nose.
You
thing,
flood
so-
enough people with white light, and
Yeah.
it gets better.
I like it.
Thank you. Caverna Therapeutics, for something a little bit different. It is a small cap, so don't judge me. Ticker is KYTX. This went up 23% in today's session, about $490 million market cap. Shares soaring after the company said its phase 2 trial of its drug for stiff person syndrome achieved statistically significant clinical benefits across all primary and secondary endpoints. The stock is up about 200% year to date. So, yeah, it's a small cap, but I just thought it was interesting.
Okay, let's go to some of the decliners. The worst performer in the S&P 500 today, ServiceNow, down 11.5%. This after Bloomberg News reported that the company is in advanced talks to buy Armis, a cybersecurity startup, a deal that could be valued as much as $7 billion. That deal could be announced in the coming days, this according to people familiar with the situation. Discussions, though, may still fall apart or another potential bidder may emerge. ServiceNow down 11.5% today. And then we saw real estate stocks take a hit today. Zillow Group and CoStar fell. CoStar owns Homes.com. This as Google tested a new real estate advertising format that could rival Zillow's services. Google putting for sale listings directly into search results, and the functionality includes full property detail pages, as well as links to request a tour and contact an agent. This is according to a report from global real estate tech strategist Mike Del Pret. CoStar shares fell 6.6%. Zillow shares fell 8.5%. The feature appears to be a test. It's only live in a limited number of markets, and right now, only on mobile. And finally, how about a bankruptcy? Luminar Technologies, LAZR is the ticker, taking a hit today, down more than 60%. This after the company filed for Chapter 11 bankruptcy protection, agreed to sell its Luminar Semiconductors to subsidiary to Quantum Computing Inc. for $110 million cash, subject to higher offers. The company entered bankruptcy with support from 91% of her first lien note holders. Luminar will use $25 million in cash on hand to fund operations during the sale process. Yeah. Shares taking a hit today, down more than 60%.
Let's take a quick look at yields here. Not a whole lot of activity, about 1 basis point lower on the short end of the curve, a slight uptick on the long end of the curve, a bit of a holding pattern as we await the next data points coming out of the government, including that monthly job report, which will now be tomorrow on Tuesday.
Tuesday jobs day. Isn't that kind of weird? It doesn't even feel right, but we'll take it. We'll take it. Let's get to some stories on our radar. Rest in peace, Roomba maker iRobot. The company filing for bankruptcy. It's going to go private. I mean,
yeah, it's not rest in peace. It's still around.
Well,
it's just not going to be public.
Yeah,
did you read the great profile the New York Times did of the inventor of this, Rodney Brooks?
No.
Yeah, it was great. It was over the weekend, and kind of they call him the godfather of modern robotics, and it was more about the idea of how far robotics has come and the idea that there are so many limitations. But of course, this against the backdrop of the company that you just mentioned, Carol, that he founded, now going bankrupt and going private.
Yeah. How would things have been different had Amazon been allowed to actually make this acquisition back in 2022?
A lot different. I do believe most of the analysts on Wall Street here. And yeah, I mean, there was a lot of concern. I mean, in all seriousness, that Amazon, when they bought it, there was a lot of optimism, but then there was a lot of criticism in the years after that, saying they just didn't really, there was no follow through, right? I mean, you couldn't get the deal done. No one was there to save them. And, they didn't have a lot of investment coming from their parent.
Yeah. Super sad, super sad. We do have some headlines crossing on Ford.
You can still buy one, Carol Massey.
Do you want to do the headlines on Ford?
I'm just letting you know.
Do you want to do the headlines on Ford?
Yeah, we should. Breaking news on Ford. Basically a $20 billion charge being taken by the company, $19.5 billion to be specific, according to Bloomberg reporting. An overhaul of the company's EV strategy. This is a sweeping overhaul, we should say, with regards to the money and the attention that it had put into those new EV models, like the F-Series, like the Ford Mach-E. Apparently a bit of a rollback in that strategy, a refocus now on hybrids and, of course, gas vehicles, all of it leading to a $19.5 billion in charges. Ford saying that in a statement.
Just fascinating to see how, the traditional big three automakers have been handling their EV efforts, trying to catch up with Tesla in a way here. You can see that Ford shares moving a little bit higher after hours, up about 2% right now. I will point out that 2025 has been pretty kind to Ford, higher by about 48% on a total return basis so far this year, and certainly extending that right now.
We're going to hear from Ford CEO Jim Farley just a little later this hour in an interview on Bloomberg TV. We'll bring that to you live across all of our platforms when it does happen.
And maybe just a little tease ahead of that, in this story, Jim Farley saying in a statement, the operating reality has changed and we are redeploying capital into higher return growth opportunities. So we'll look forward to that conversation Matt's going to have with Jim Farley. All right, guys, that is a wrap.
Thanks, Carol.
You're welcome.
Thanks.
Here for you. All right, that is a wrap.
Give the lighting guys.
I know.
Nice
Billy and crew, they know what they're doing, don't they?
I get a little extra something this holiday season. All right, that's a wrap. Our cross-platform radio, TV, YouTube.
What are Katie and I getting from you?
I don't know.
It's in the mail.
Didn't you have some of my cookies? No. Okay.
I can't hear Romaine. I think they cut his audio or else he didn't say anything.
Sorry about that. We'll get back to you, Romaine. All right, that's a wrap, guys. We will see you again, same time, same place tomorrow.
When we come back, a deeper dive into that breaking news out of Ford, a $19.5 billion charge. But the real kicker here is the idea of a bit of a rethink of its EV strategy, converting some of those EVs into hybrids. A conversation up ahead with the CEO, Jim Farley. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. We start off the week, well, similar to how we started off last week, a bit of a holding pattern for financial markets as they await a data point that gives them some guidance on what the Fed might or maybe might not do. The S&P 500 down about 0.2% here on the day. Similar story for most of the major indices, with the Russell being the big decliner on the day, down about 0.8%. Yields in a holding pattern as well. And you are still seeing a little bit of a bid into safety and a little bit of a shedding of risk appetite. That's reflected in the record run that we continue to see for silver and the continued doldrums that we continue to see for Bitcoin.
Well, I managed to find some action in the equity market. Let's go there now. ServiceNow, one of your big losers on a percent basis on the day, down more than 11%. That potential deal for Armis, Bloomberg Intelligence says it looks expensive. Broadcom, also that bad week it had last week continuing into this week, down by about 5.6%. I did find some good news when it comes to Tesla. Shares higher by about 3.5%. All of this brings us to our top story this hour, and that's Wall Street gearing up for key economic data as the last full trading week of 2025 gets underway. October retail sales and November jobs data due out tomorrow, with the payrolls report in particular expected to show a sluggish labor market. Now, this comes as financial anxiety hits an all-time high. Financial advisory company Betterment releasing a new survey showing that nearly half of employees now say they need over $1 million to retire comfortably, Romaine.
Absolutely. And, well, who can shed some light on that? Well, no one better than the CEO of Betterment. Sarah Levy joins us here in Studio 2 to talk a little bit more about those findings and some of the other trends right now in the investment community. Let's start off with retirement goals and whatever that dollar value is that most people think they may or may not need in order to retire comfortably. Have we moved further away from those goals, or has that number just gotten bigger?
I think yes and yes.
Okay.
So at Betterment, we've done this study now for 5 years, and we've seen some very consistent trends. One is the numbers moving higher. The second is that anxiety is at an all-time high. And at the same time, we're seeing, on the more sort of optimistic note, we're seeing more and more folks participating in retirement programs at a greater clip. So hopefully preparing for that, eventual need.
Are these voluntary programs, or are they through their employers, or
through their employers?
Yeah.
I mean, I think there's been a lot of great legislation in the last couple of years, both at the state level and at the federal level, really pushing more and more companies to offer retirement solutions and to require employees to participate in those solutions. So that's been a great trend, maybe not enough still when we see that $1 million number and we see how far people are from really achieving that number.
Well, let's talk about that $1 million number, because it's interesting that is up sharply from last year. And you think about what we're dealing with right now, what we're dealing with last year in terms of inflation, not too much has changed. What are some of the factors that contributed to that jump?
Well, I think the biggest story right now is near-term anxiety, and we look across generations, and not surprisingly, we're really focused more on Gen Z and millennials. Not surprisingly, that group is actually fairly optimistic. Even though the number's going up, they're optimistic that they can get there, and our hypothesis on that is really just about time, right? They think that retirement feels like it's a long time off. I think the challenge with that is that if you don't get started now, quickly that time, sneaks up on you.
Are they getting started now? I mean, relative to the older generations, are they getting started earlier?
Relative to the last 5 years, I would say the trend line is good, is positive, but it's still not enough. And largely the trend line is positive because new companies entering to support their employees with retirement are sort of required by law to get their employees investing. I think the challenge is there's a bunch of what I'll call lost employees who are stuck in sort of old plans where they weren't required to participate and they may be being overlooked.
Well, I want to talk about the other end of the spectrum, because in that graphic we have up right now, Gen Z, as you said, leading in retirement confidence, boomers delaying retirement. Talk a little bit about that. And when we say a delay, I mean, how dramatic are we talking about?
Well, I mean, I think it's sort of common sense in that boomers are, at the doorstep of retirement, and either you're ready for that or you're not ready for that. And at the same time, there's an affordability crisis going on, right? The cost of housing is up, the cost of gas is up, the cost of food is up. So I think what we're hearing in these surveys is people who are sort of on the precipice of retiring are saying, well, I don't have enough, so I got to stick it out a few more years.
There's also the issue, too, of, I know everyone's focused on affordability, but for certainly for boomers. Some of them sort of came into investing, the housing market, et cetera, at a time where the returns, the rates, et cetera, were very favorable. And I've heard this as I have family members who are at retirement age. It's hard for them to sell their house and buy a new house in somewhere warmer because the interest rate differential is just too great for them to handle. And I am curious as to whether we're just talking about the base effects that's scaring them or whether there really is something in the future when it comes to inflation and affordability that they should be scared of or worried about.
I think Social Security is the piece of the puzzle that we haven't hit. And I think that there's a real fear that Social Security is not going to hold up. And, you know, the different projections are as soon as 2030 when Social Security starts to get to a point where it's not able to get the job done. And so I think that's actually the missing piece. It's not just that they can't get into a new house or sell their home, but it's also that that safety net is, you know, is not as secure.
I am also curious, you know, you think about people approaching retirement age, maybe putting it off when they take a look at their 401ks. This year has been another fantastic year in the market relative to history, but there has been a lot of volatility. And certainly if you checked your 401k at certain points in this year, you could get pretty nervous. And I wonder, you know, do you see that sort of behavior factor in at all?
Well, in general, we would recommend in a 401k that you're in globally diversified low-cost funds. And I think those who follow that advice generally see that on average and over time, the market is going up and to the right, right? So I think that's not as much a concern. And in 401ks, people tend not to be in and out of the market the way they can be, you know, in sort of taxable investing.
With regards to 401ks and just the overall retirement plans overall, do you anticipate we're going to see more of an uptake of private assets into some of those funds, assuming that the regulations are clear enough for that to happen?
It does seem like that's where it's headed. I mean, I think the challenges historically have been liquidity with private assets and then the cost structure, right? I think at the moment, the folks who really want private assets in retirement are the supply side, right, who have had trouble getting out of some of those investments. So I think what we have to be careful of is that retail investors don't become a dumping ground for, you know, other assets that, you know, investors can't get out of. But I do think with more companies staying private longer, a ton of the wealth accumulation opportunity is happening on the private side, and we need to find a way to make that more accessible.
Absolutely. Sarah, great to get some time with you. Really appreciate it. That is Sarah Levy. She is the CEO of Betterment. Now, coming up, a busy week of eco data ahead. We'll discuss with KPMG's chief economist, Diane Swonk, up next. This is The Close on Bloomberg. Well, after a number of delays from the government shutdown, we're set to get a slew of eco data this week. First up, we have tomorrow's souped-up jobs report, which will include November payrolls and key statistics, such as the unemployment rate. Here to discuss is Diane Swonk. She is chief economist over at KPMG. Diane, great to have you with us. So we are finally getting the data. It's a little bit more delayed than it normally would be, but I feel like this is one of those reports, as several of them are, where there's a lot of questions about data quality, about the collection methods. And I wonder, you know, with that in mind, how you'll be taking a look at some of these numbers.
Well, I think you do have to be a little careful to take them with a grain of salt in that we know that the government reopened on November 12th. That is the survey week for the employment report. And even though they don't usually do it till after that, it takes them a while to ramp up. We know it takes them more to actually reopen agencies that have been shut. And we also know the Bureau of Labor Statistics is already down 25% on its staffing from the beginning of the year. So they were already operating shorthanded and short-staffed going into the shutdown, and that continues today as they try to catch up on this data. And what really we have questions about will be more on the household survey side for the month of November, and that is, you know, you're going to be asking people a little bit off kilter in terms of the timing. You know, what were you doing that week? Were you looking for a job the week that they reopened up the government? And even though the way these surveys are done, there is a lag, there's more of a lag this time, and that's something that you just don't know how people are going to remember exactly on that side of it. But we should get a better view on the actual payroll numbers, which are not expected to be terrific either. For October, we have the 151,000 that took off previous buyouts from the federal government. That's a big weight when you're sort of not averaging very much in payrolls each month. And then in the month of November, the real-time data we have was not terrific either. So we're really within that zero of, you know, sort of not significantly different from zero. Even if we get a little positive on that other 2 months, I actually think there's a good chance we'll see red ink on the 2 months combined.
I'm curious how you think that the Fed, a divided Fed at that, will be reading these numbers. It was interesting to hear from the chairman last week to summarize, basically saying that we could have been overestimating hiring in previous months. That seemed to be a little bit more dovish than maybe folks had been anticipating. I wonder how you took that comment.
I actually think it's right, and we know that the revisions will be to the downside, and I don't think it's too surprising. I think most people within the Fed on the revisions are on the same page. The question is, how close are we to the edge of sort of this being just an uncomfortable, balanced labor market, or are we really starting to see a deterioration? And that's what, is sort of the debate is at, is it enough of a deterioration for people to push back and consumers to say, we won't take these higher prices, or are we dealing with a situation where you could have weakness in employment and at the same time more of a stagflationary kind of scenario where the CPI data, although price of gas is down, price of just about everything else is not. And one of the things we'll be watching for later in the week is what are service sector prices doing? We have seen tariff prices go up, goods prices go up in response to tariffs. That's what the Fed expected, and it's less than we had seen in April because tariffs aren't as high as they were expected to be. So that's all good news. On the downside, though, has been this stickier service sector inflation that has not gone away. And in fact, that's what we're going to be watching really closely because that's going to be a bellwether on how much additional inflation we have to deal with going forward.
Well, what about the sticky side of this? It was interesting listening to Myron this morning. He was speaking at Columbia University, and he specifically cited portfolio management fees as one of those sticky areas, but he also called it a, quote, statistical quirk that, in his view, wasn't really a reflection of actual customer experience.
Well, certainly on that side of it, I agree with them. On the side that I'm more concerned about is when I'm seeing service sector inflation like in-home elder care going up at its fastest rate on record in the month of September, and childcare, which has already been going up several multiples of the overall inflation number on the PCE data. It actually went up at one of its highest rates since the 1990s in the month of September. Those are areas where we tend to see a lot of immigrant labor, and they're areas that we know as well that we're starting to hear from smaller businesses. They're having some hard times finding workers in areas that they once did. That's where the immigrant worker has been dominant. And I think it's important because we're even seeing in those areas, we're going to be looking very carefully, is there going to be upward pressure on food processing, on food preparation, in accommodation, all of those things going forward, because that's an area where we could see more service sector inflation, aside from all this sort of statistical anomaly that's in the portfolio side of it.
But how does the Fed sort of factor that in? Because they already are excluding housing, food, energy, obviously some of the biggest inflationary costs that most regular people have seen over the last few years. You throw in some of the issues that you just talked about with care, et cetera. It's easy to strip all that stuff out and say, okay, things are fine. But at what point does that become a broader economic problem, more importantly, one for the Fed and markets?
Well, I think what probably becomes the biggest economic problem in the first quarter, we're going to be getting record refunds, tax refunds back in the period of March through May, most of it in March and April. And those record surge in tax refunds, that's great, but we know this. We've been down this road before. When you get fiscal stimulus on the heels of inflation, that inflation tends to stick, and you tend to get more opportunistic pricing, which is the pricing of someone that may not be facing tariffs, but they've seen other prices pick up, so they're raising prices as well, or that spillover effect into the service sector. And that's what we're going to be really watching very closely into these other service sector. We know, for instance, insurance costs, health insurance costs, no matter what, are going to be going up a lot. And electricity costs are going up a lot. Natural gas, all those things matter.
All right, Diane, always a pleasure. Diane Swonk, Chief Economist over at KPMG. Stick with us when we come back. A closer look at that breaking news on Ford, a sweeping overhaul of its EV strategy. A conversation up ahead with the CEO, Jim Farley, right here on The Close. All right, just a few minutes ago, we learned that Ford is undergoing a sweeping overhaul of its electric vehicle business. It's going to amount to about $19.5 billion in charges. It's also going to include scrapping its next generation electric F-Series truck as it shifts gears to a hybrid. Joining us right now to talk a little bit more about this is the host of Bloomberg's Open Interest, Matt Miller, and he brings along with him the CEO of Ford, Jim Farley.
Jim, thanks very much for joining us. This is a major pivot, to say the least, but I think we could all see it coming because the consumer basically helped make this decision for you. Tell us what's driven these plans.
Well, as you said, it was really the customer changing their decision. You know, we saw hybrids really take off last couple of years, like, you know, last month we had a 30% increase in our hybrid sales. We're now number 3 in I think we're 80% hybrid market share in trucks. So we saw this happening. We also saw the more expensive EVs, you know, really suffer in the market and the more affordable EVs to do better. And then the last couple months, it really was remarkable. The EV market in the U.S. went from 12% of the industry to only 5%. And that really, in the end, was the big decider for us. But look, we're going to 50% electric. It's going to be hybrids and E-Revs and electric. It won't be just pure electrics.
So, you know, every good trader knows you got to cut your losses when you recognize there's an issue. You're doing that in this sense with the F-150 Lightning as we now know it, and the T3 project, the next generation truck that would have been built in Tennessee. But you're able to, I guess, salvage some assets, and as a result, you've raised your profitability forecast from $6 to $6.5 billion for this year in terms of EBIT to $7 billion. Where are you gaining an opportunity from this, Jim?
Well, great question. This year, in the short term, it's really our cost of our company. Our quality is getting better, and so our costs are much more competitive. In fact, the Novelis aluminum has cost us more like $2 billion, but we're still raising guidance. Look, for this announcement, Matt, it's really about moving to more profitable vehicles. You know, we're going to make in Tennessee now an affordable pickup truck. I think it's going to really surprise the market. These are customers we know. Not a lot of guesswork in terms of the revenue, the cost we need to get at, and a more affordable van in Ohio. So these are going to be better investments for the company profit. And all those hybrid sales, you know, those are really profitable vehicles for us as we basically deploy hybrid across our lineup. But we're also going into the energy storage business to 20 gigawatt hour. You know, that's a big move. We're going to convert our battery plants from automotive batteries to energy storage batteries using LFP. That's also a big pivot that is profit positive for the company.
Jim, with regard to that pivot and the energy storage side of it, do you anticipate any concerns by the White House, by the administration here in the U.S., that you are partnering effectively with the Chinese company in order to do that?
Mm-hmm. Well, look, it's our plant, it's our people, and we designed it that way. We have a licensing agreement, but we feel like it's better to build these batteries in the United States with American workers, with our own Ford workers, and understand the IP than to import them like they're being done today. The best way to compete with the Chinese is to get close to the IP and then run the plants at Ford. When Ford knows how to build things, we know how to do this. So I think this is much better than for America. We're talking about thousands of incremental jobs versus importing batteries like we say today. Much better for America.
Well, to continue on the energy storage business, you mentioned that this will be profit positive for the company. And when it comes specifically to that new business line, how long would you expect before that alone becomes profitable?
Yeah, great question. Well, we're busy now. We have to move this business moves much faster than the auto business. We're converting our Michigan plant as we speak with all new equipment to make energy storage, which is slightly different than automotive with the LFP. And then we're building a whole new plant, converting Kentucky 1 to 20 gigawatt hours. And that will be landing in late 27. We're going to be selling and servicing batteries, not just the cells as a contract manufacturer. We're actually going to be selling the huge storage containers to utility companies and the AI data center companies in 27. We're already out there quoting this business now. We know what kind of price points we need to get to for it to be profitable. And this is not our first rodeo as a manufacturing company.
It looks like, Jim, that we've gotten new regulations or seen older regulations scrapped, both here and overseas, right, in terms of what's necessary. I'm wondering if the administration here in the U.S. and the EU have helped you and other car makers really serve customer needs better, because we're seeing your rivals also bring back products that were previously canceled, like the Hemi over at Stellantis, that customers wanted.
Well, look, I think, I was at the White House with the president. He announced the revised CAFE standard. Anything we can do to get the regulations to look more like customer demands. Look, we're going to 50% electric. There are no gas guzzlers in our future at Ford, but we want to offer customers choice. And I think that's what the president is trying to do, is just to give people choice. We're going to have this affordable electric vehicle built in Kentucky. I think it's going to be a huge hit with Americans, but it's going to be part of a broader portfolio with choice. And we're seeing the same thing in Europe. We're seeing the same thing around the world. Look, we all want to lower our CO2 footprint as industry. That's what Ford's going to do, going 50% electric. But we need to give customers choice and then use our manufacturing flexibility to go with where the customers are. And that's what this announcement is about, having optionality.
Jim, though, it's not only about powertrains, right? I mean, one of the other things customers want is repairability. And I wonder if, because you already make the F-150 in Kentucky, you make it in Kansas City. My Raptor was born in Dearborn, where I was happy to pick it up years ago. But the new trucks are aluminum bodied. Are you going to be able to build steel trucks, for example, at the Tennessee plant?
Oh, that's a good question. Well, I'm not going to give, because if I tell you, Matt, I'm telling all my competitors. I'm not going to do that today. All I will say is we are coming out with affordable vans and pickups that Americans are going to love. And we're the #1 brand for both those segments. And they are going to love these new products. And they're going to fit into what Americans are buying today. And they're going to be low CO2. And they're going to be more affordable. That's all I can say, Matt. I'm not going to give anything to my competitors.
All right, you don't have to give anything to your competitors, Jim, but I am curious if you can just speak a little bit more to investors. First, about the $19.5 billion charge.
Sure.
But also obviously it's huge, and we talk about this idea as to whether this will be it or whether investors should anticipate potentially more costs associated with the unwind.
Well, look, we're unique from our competitors. We don't have plants that are electric. We have a whole business that's electric. So we looked at that whole business and evaluated the valuation of the assets, and we made these decisions on the future products. The bottom line is the cash subset of that is about $5.5 billion of the $19 billion. And the ROI on that $5.5 billion is very attractive. These are great products. They're affordable. That's where the market is today. And we're going to have great powertrains for them, and they're going to be able to buy more affordable Ford trucks and vans than we have today. And we know there's going to be a profitable business for those out there. So this is a better allocation of capital. That $5.5 billion of cash is going to be a great investment. It didn't make sense to keep plowing billions into products that we knew would not make money. We had to make this choice.
I hear what you're saying there, and certainly the market spoke, but what gives you the confidence that you think about 2029, the goal to have a profitable EV business? You've been losing billions in losses on EVs.
Yes.
What gives you the confidence that you'll be able to turn that around by 2029?
Well, we think to make that business profitable, we have to get to a BYD cost. And so this Skunk Works project called the Universal Electric Vehicle that we're making in Kentucky, that is designed to match the BYD cost in like a Mexico. And we really believe we have that delivered. We've sourced all the parts now. We're testing prototypes. We're starting to run the production line. And so we have real confidence that we can do that. And that's why we're telling people that we think we'll be profitable. We've worked hard for the last couple of years on this EV project, and we have fully competitive costs with the Chinese. Now it's our chance to bring a pickup truck with that low-cost EV to Americans. We think it's going to be a big hit.
Hey, I want to ask about the Chinese because while I love it when companies go back to steel and V8s and stick shifts and handbrakes, obviously many people are betting the future is on EVs, autonomous vehicles, and the Chinese are certainly making real strides there. As you make this pivot back to sort of the classic American pickup truck, what will you do to keep up with the Chinese as they continue to make strides forward?
Make no mistake. Our strategy as a company is to give people choice. Part of that choice is to have fully competitive costs with BYD localized in North America. Matt, we are going to have a fully competitive BYD EV built here in America for Americans that we believe are going to be profitable. And to do that, we had to massively innovate, bring LFP to the United States, reduce the manufacturing content of the vehicle radically, redesign the whole assembly process, engineer the vehicle with all new suppliers. It's a whole different approach on the whole engineering of that vehicle. We are here to compete globally. We're not going to cede our future to the Chinese. And we're the most American car company, but even for us as the most American car company, we're a global company. And that UEV product is the heart and soul of our competitiveness for the future. But the Chinese don't know the truck customers like we do. And we know customers want E-Revs and they want hybrids and they want Raptors like you have. It's a diversity of all that lineup that makes sense for us to compete and win against them.
All right, Jim. Always appreciate you taking time for us. Got to leave it there. Jim Farley, the CEO and president of Ford, and our thanks there, of course, to Matt Miller, who co-hosts Bloomberg's Open Interest program at 9 a.m. Eastern Time. All right, we keep an eye on those shares of Ford now. Katie, up about 1% here in the after-hours trade.
Yeah, interesting to see that little bit of an uptick, not quite at after-hours highs, but we'll continue to follow that one. But from powering electric vehicles to powering the AI transition, data center investment could rise a staggering 118% in 2026, according to a new analysis. That's a potentially substantial catalyst for the real estate companies that are making it all happen. But our next guest warns that power availability could pose a problem for those seeking new opportunities in the data center gold rush. Joining us now in studio, I'm pleased to say, is Michael Levy. He is the CEO of privately held real estate investment and development company firm Crow Holdings. Michael, great to see you in person.
Great to be here. Thanks for having me back.
So let's start there. Data centers, the talk of the town. We know that has made ripples across every sector, AI, and certainly in the real estate market as well. Talk to us about what you mean when you say that we could start to see new opportunities be crimped a little bit here.
I think what's happening right now is power availability across the country is getting gobbled up by developers of data centers and other uses. And so, for example, you have systems which might produce today 50 gigawatts for their whole municipality and municipal area, and they have queues of 100 and 200 gigawatts of power requests coming in from data center operators. There's no way they have the infrastructure to meet these needs. We have not been building power generation in our country in terms of gas plants or nuclear plants or the type of power we need to come on. And so ultimately, you've got a major mismatch of supply and demand of power. And what many of the energy companies are now doing is they're going to developers of data centers and other real estate and saying, you might want that power. We need to make sure that your request for that is substantial. So we'd like you to put up huge deposits multiple years in advance. And that's starting right now. And those deposits can be as large as $1 million per megawatt hour. And so, it could be $200, $300, $400, $500 million for a new project. And that's beginning to creep its way in the marketplace.
Right.
And that will, by itself, begin to restrict the supply of opportunity.
It's fascinating, especially when you think about that supply and demand dynamic and the fact that, when it comes to some of the power generation that hasn't been built, it's not like you can switch that overnight. But I'm curious to know, is there any moment in time that we can compare this to? This idea that you're seeing these huge deals signed years in advance. Have we seen something like this before?
In the real estate industry, I have never seen a level of demand for an asset class and so much capital chasing one part of the marketplace. Now, to be clear, this is not real estate. This is the intersection of power, compute, and real estate. And if you've seen these largest facilities, we're now in an era of railroads and tunnels and bridges and huge public infrastructure projects. So this is a very different business than than just a straight up real estate business.
Well, I am curious just about other sort of building that we've seen in the industrial space, outside of just data centers specifically, because it seems like there's been more activity there. I guess my question to you is, are you seeing that activity? Are you investing in that activity?
We have, through our activities as a real estate developer in the United States, we have come across land that has proven itself to be very valuable. As opposed to, our company did not design itself to be a data center development company, but we have come into that business because of the land holdings that we've had and just the highest and best use for that land. So yeah, it's come at us, and it's an attractive part of the business.
Where are we going to see more of that industrial, in terms of the types of sectors, that industrial capacity that comes online in terms of the land use? Where is that going? Like, who's basically using that stuff?
Well, I think for data centers or for more generally?
Just overall.
Just overall.
Yeah, not just data centers.
Look, I think what we're seeing in America and continue to see, generally speaking, not entirely, but towards the Sun Belt, where America's manufacturing base is being rebuilt today. Just today, we're talking about a zinc smelter for $7 billion being built, I think, in Tennessee. Yep. And you're watching whether it's Arizona, whether it's Texas, whether it's Georgia, whether it's South Carolina. This is where the new manufacturing infrastructure for the United States in the 21st century is being built. And ultimately, that creates tremendous demand for real estate around those facilities. Yeah. And that is our backyard, so we're excited about it.
Absolutely. You guys have done a great job over the years. Always great to talk to you, Mike.
Likewise. Thanks for having me.
Michael Levy, the CEO over at Crow Holdings, a closer look at the industrial real estate sector. And now we kind of stay in the real estate space, but focus a little bit more on home builder sentiment, which has gotten a little bit more constructive this month, rising to its highest level since April. Our next guest, she runs the oldest minority and woman-owned design and construction firm in the country. Joining us here in Studio 2 is Cheryl McKissack Daniel, the president and CEO of McKissack & McKissack, which today announced her new role as chair of the board effective in January. Great to have you, and congratulations.
Thank you so much.
Absolutely. And before we actually get to that part of it, I also want to talk about another piece of news here, which was we saw the New York Gaming Commission finally approve that license for Steve Cohen, that big project going on in Queens, New York, to build a casino. You're a part of that.
I am.
You think this is a good thing, and I am curious about what that development actually looks like when it's completed, beyond just the sketches. What is the overall vision for this complex? And for our viewers that don't know, this is basically a sports complex. It includes Met Stadium and across the way, the Arthur Ashe tennis complex.
As well as a lot of affordable housing that is currently being built. The new project will be $8.1 billion. Of course, it'll include the casino and hotel, but it'll also have this beautiful park space for the residents of Queens, as well as a new MTA station. I don't know if you've seen that station recently.
Oh,
but
I've been there.
Pretty bad.
Yeah, I avoided at all costs.
Yeah, so new parking garages. It will be a transformative project for the Queens.
It's interesting you bring up the MTA. I mean, your firm has been an advisor to fill a lot of MTA projects over the years. I mean, building affordable housing or building a casino is one thing. Improving a subway station or a train station seems like a much politically fraught process, and I am curious as to how you navigate those types of projects when it's not just really about the dollars and cents, but it's about all of the regulation and bureaucracy that comes with it.
Well, it's part of the $1.7 billion give back to the community that the owners of the casino wanted to do. And so improving this station was paramount to that, because that's how people will get there. The station right now is not safe. It doesn't look anything like that you would want to walk through. No. But now with the new casino, the station will have access right on the main floor of the development. And so it's perfect.
I am curious, how the regulatory landscape has changed for how long you've been in business. When it comes to building affordable housing, when it comes to, improving stations, I have to imagine there's a lot of red tape. Has that always been the case? How has that evolved over the past several years?
It's always been the case in construction in New York City. There's always been a lot of red tape. There's always been complaints about how long it takes to get permits out of DOB. We're always trying to change that and streamline it. Just getting insurance in construction is very difficult. And of course, that goes to the state. And how to deal with the scaffolding laws that made our insurance extremely high.
I guess I'm wondering, has it become more onerous, or have we always been at sort of these levels?
We've always been at these levels. It is not an easy place to enter when it comes to construction and real estate.
No, and particularly New York. I mean, anytime
Yes.
you talk to national real estate developers, I mean, there are some that don't even want to deal with this city. And
Absolutely.
state. And the few that do deal with it, they just grumble about it the whole time. But I'm curious, but I mean, you've obviously been here for quite some time. Your firm goes back over 100 years, and you've been instrumental in a lot of big projects, including the recent redevelopments we've seen at the airports, two major airports here. Are you hopeful that we will see maybe some changes to the regulatory mashup here in New York City and New York State with the new administration coming in terms of the mayor, and maybe potentially a new administration for governor in about a year's time?
I'm always hopeful that things in New York will be streamlined. And, you know, the onus right now continues to be on, you know, the working people of New York City with the high taxes that we pay, you know, state and city taxes. You know, so I'm always hopeful that we will be a much friendlier place to do business. Will it happen? I don't know.
Have you spoken to the new mayor or anyone from the state?
We have. I mean, the mayor is now in the process of trying to figure out who's going to lead DOB. And, you know, from the selections that I've seen so far, I think they've been excellent. I think they're people who know the city and understand what we need to change here. But it's always a process.
So conversations happening, though, selections happening, though, certainly a good sign. I do want to talk a little bit more about your new role as chair of the board. As Romaine said, that becomes effective on January 1st. Talk us through that decision, you know, to step into that role and what the succession plan looks like at your company.
So I've been working on succession at least 3 or 4 years. And I decided that the management side would be easier than the ownership side. And so, you know, at first I tried to bring people in from outside of the company, but the culture, our culture is what it is, and it doesn't necessarily work for people coming from other companies, especially a company that's not like ours. I mean, you know, the type of services we provide and the fact that we're a family-owned business, and a lot of our senior leadership has worked with us for 20 years. So after the last try, I said, you know, let's do this internally. And so we began to start doing 360 reviews for our senior leaders and having our executive coaches come in and work with us and collaborate on what this would look like. And then I had to go in for a major surgery last February. And I'm like, well, this is it. This is the time to make this transition at least temporary. And so during that time, I was able to see how good it worked out. And now I'm making it official January 1st.
All right. Well, we're going to keep an eye on you. We have to get you back in the new year to talk a little bit about how that goes. Of course, a company, of course, founded by your grandfather more than 100 years ago. It's been a family business for quite some time. Cheryl McKissack Daniel is the president and CEO over at McKissack and McKissack. She's also the author of The Black Family Who Built America, the McKissacks, 2 centuries of daring pioneers. Definitely something you want to check out, and a great story, really great story here about what they built over the years. We'll be back in a moment, setting you up for what to watch over the next 24 hours. This is Bloomberg. All right, let's push ahead to what the markets will have their eyes on over the next 24 hours, and it's going to be on that economic data.
Yeah, absolutely. 8:30 a.m., that U.S. November jobs report, plus October retail sales. A lot to dig into there. A lot of it's stale, though, you have to say.
A lot of it's stale. That comes out at 8:30 a.m. About 9:45, we're going to get those S&P Global PMIs. That'll be a little bit less stale, both on the manufacturing and services side.
And it's interesting, at 11 a.m., we have the Cisco annual stockholders meeting.
Wow.
Cisco finally recapturing its all-time highs, and they're going to talk to the stockholders about it.
Also getting some earnings still trickling in, this time from the home builder Lennar. That'll be after the bell tomorrow. We'll have full coverage of that right here on The Close, where I think both Katie and I will be back tomorrow.
Yes, every day between now and December 24th.
Stick around for all your politics coverage. The team at Balance of Power, they're coming up at the top of the hour right here on Bloomberg.